Traders, welcome to Charts and Coffee. Great to see everybody. Happy Wednesday, everyone. And well, before we dive into the questions, I just wanted to make sure we take a look at the calendar this week because I've been getting a lot of questions about this next Fed meeting, this next FOMC meeting, and what kind of messaging ultimately Jerome Powell and company might communicate. And the idea here is this. Everything they do is usually going to hinge on the data, right? They can lean on the data. When the inflation was flat, it was transitory. When the inflation trajectory continued higher and didn't flatten, they caved, right? So, I'm not saying they're data dependent, but they are going to use data to defend their monetary policy messaging and action. Now, as we go into Wednesday at 10 a.m., we've got the JOLTS job opening numbers. And this type of hot zone isn't one that I typically will focus a lot on. If, for example, if we have a situation where we have a central bank as we do now that has a second mandate, inflation and jobs, these kinds of data points are going to be important. And then, of course, the inflation when we get into Friday with the CPI is going to be big. So if you want to know, fast forward 5 days from Friday, what kind of messaging we might get. Do we end up seeing Fed fund futures bring in expectations for a rate hike closer than June? This is how you can measure this. We don't have to guess at it. We can understand what traders and investors are thinking about when we look at the May and June contracts. And so this is, for me, how we can measure the psychology, look at the data points, look at the way in which the Fed fund futures respond, and then we'll get a better idea of what we're dealing with, possibly as far as any more shortening of the timeline to the eventual hikes. All right, so let's kick it off with thoughts on NG. So hope for the world. I'm going to tell you right now, I'll do a much better. I did a much better job than the very short amount of time we'll have here. If you head on over to the Simpler Trading YouTube channel, which I'm guessing you're probably on right now, just yesterday, I did a video called What's Next for Natty Gas. So Cliff Notes version, I'm not really that interested in trading it, but a lot of folks have been asking me about it. And I talked about a potential pattern and where the upside could be in a bounce, but also ultimately that this is a downtrend now. So check that video out. It's the free video from just last night. Dove into a lot of detail about the setup, the seasonals, and where we are now within the structure. So I think you'll really enjoy that. So thanks for the question. All right, next up is I placed a $200 call on Apple 2 weeks ago, May 5, 2022. I'm up 34%. Cool. Should I consider selling this option early? Brett, I don't know what your plan was. First thing I'm going to tell you is, what was your plan? What was your target? I mean, you've given yourself a lot of time. So clearly, you're probably embracing a trend or structure, and therefore time horizon that's probably somewhere between a daily and a weekly. I don't know what the plan was, but here's what I'll say generally, right? You got long, which is cool. You have an out of the money option, which is clearly up because of the way in which we're getting the volatility in the direction of your call. So, if your target was 200 and you've given yourself till May, that's fine. Here's what I'll say to anybody, aside from the Apple trade. Anytime you say to yourself, gosh, I'd really like to pay myself and protect my unrealized profits or protect a certain percentage of my unrealized profits. I don't know how many options you have, but one thing I would say is, why don't you scale out of some of the options? I don't know how many you have, but why don't you scale out of some of the options? Maybe take a few of them, maybe take a quarter of them, half of them off the table. Half might be a little too much considering how much time you have, but maybe take some of them off the table. Maybe move the stop to a break even. So you'll risk all your unrealized profits, but you won't let the trade go against you. maybe trail to stop. I'm not probably advocating the last. I would say, what we do in the sector secrets mastery, because I think a lot of traders run into this situation is scale out. Maybe there's an optional target, which is what I'm guessing this may be for you, and move to a break even stop. And then that way, you paid yourself and you can then manage your trading plan with probably a little less emotion. So I hope that helps. All right, next up, and thanks for the other members chiming in. I love that. We do a lot of that in the mastery. Love that about our community, traders helping other traders out. I love it. All right, so next up is, what do I think about the Russell? Hey there, Hobo Historian. What do I think about the IWM? Historically rally starting in December. So there is an interesting tendency for the Russell to benefit from tax loss harvesting, tax loss selling. And that's, definitely a December phenomenon. But aside from the seasonals, I'm going to go back to where my analysis is always rooted, and that is structure first and strategy. So this is a look at the Russell via RTY, which is ultimately then going to map to what, if anything, we can do in the IWM. We had an uptrend, and then, my gosh, did we not chop pretty much all year long? And since the trend that preceded the chop was up, and we're still flirting with support at the 200 exponential represented here by the dots of the simpler propulsion. Let's zoom back in now. All right. So what are we working with? We're working with a market that still has largely a bullish directional bias. And if you take a look at the structure, and how can you gauge structure? Really simple, gang. You can use an 8, 13, 21, and 34 exponential moving average. What we do here on this chart is we simply turn it into a color-coded indicator, because I like my colors. And we say, look, this is a neutral underlying market. Yeah, some bearish momentum, some bearish sentiment, hence the top row is red, but the bottom row, the much less twitchy row, is neutral, yellow. So if I'm neutral, the trend that preceded this non-trending environment is going to dominate what I think ultimately could happen. So am I surprised to see us move higher? I'm not. I don't know how much further we'll go. One of the things that I mentioned to folks in the rooms was 2,300 is likely going to have some selling pressure. And if we were to go red on this lower row, so we're double red, that's when we might get a short. But I don't have a short yet. I'm always going to short from higher. I'm never going to short from lower. And if the market is neutral and the trend that preceded it was up, well, then we're just looking for an oversold buy, right? That's what we're looking for, an oversold buy. So now you layer on that historical tendency. Now you can layer on seasonals and things like that. And if the seasonals and the structure, if that tendency that we have for this month and the technicals are dovetailing nicely, you've got a really good opportunity here for at least a little bit more upside before we pause and we see if this market really wants to then take the halfway mark out and keep heading north of 2,300. Now, all that's going to then become the same conversation about IWM. So anytime there's a futures contract that has a ETF alternative, as this one does, I'll look at the futures, set that up, but execute the idea on the ETF. So hope that helps. Great question. And IWM's been coming up a lot. People are asking if I'll short it. And my simple answer succinctly is I cannot. I don't have the structure to justify it. All right. Next up is why is there so much volatility in crude? Sure. um, of late in both ways. Stop loss hunting? No. Look, I think a lot of traders, there's two ways I think a lot of traders look at the markets. One is a very adversarial. They're out to get me, they're out to bust my trade up, they're going to run stops. And there's the other one, which is the market is a huge place, much like an ocean, and I'm a surfer. Does the ocean do anything different for a surfer on the water? Doesn't even know it's there. We're the latter. The market's never out to get us. So stop losses, stop hunting. There's no such thing really. Think about it for a moment. Some of you might say, wait a minute, Rog, you tell me they don't hunt stops? Again, they're just looking to fill orders. There's an entire group of market participants whose job it is to seek out where there's a nice liquid level, fill the orders. That's how they make money, right? So I've always looked at it in that way. Naive, maybe, but it keeps me from feeling like the markets are out to get me, which frankly is a little arrogant because I'm going to say the markets don't even know I exist, which is fine with me. I get to operate through these woods like a ninja. I'll take it, right? So stop hunting. I don't believe so. Markets always move in the direction of the most stops because there's an order filling sort of psychology behind much of the ebb and flow of the market. So specific to crude. Crude first sold off because remember, crude is really sensitive to the ratcheting up of the pandemic narrative because the immediate expectation is ratcheting up a pandemic narrative, variants, anything that makes, kind of it kicks it up worse, expectations immediately go to less demand for crude. So crude always takes it on the chin with that narrative. Remember, at the same time, there was conversation about a coordinated effort globally. 4 or 5 countries would release petroleum reserves. Another reason for the move lower. Then OPEC had meetings within a few days of that sell-off. And then OPEC even preempted their meeting by saying, look, we'll consider decreasing the production increase, right? We'll just cut supply. And then that's, I think, where you started to see everything level out. But in the meanwhile, the damage has been done. And I don't know that we're going to see $80 crude again anytime soon. We have a downtrend now. So again, think about all the narratives that this market, crude oil, has to discount, has to price in. And that accounts for a lot of the volatility that we saw. And I think we'll continue to probably see for a little while longer, but it looks like it's settled down. One of the telltales of a market, quote unquote, settling down is that it then contracts after a brief period of higher volatility. It contracts back into its typical daily price movement range. Volatility, historical volatility specifically, is an unbelievably powerful tool for us traders. And so when we start to contract back inside the normal price movement, then we know that things have settled down. All right. So I hope that makes sense. All right. Al asks, good morning. Would I please expound on the validity of the trade and taking paper cuts? Also looking at HMC. All right, let's start with the symbol here. So Honda, downtrend, short the rip. That's a pretty basic one. Am I focusing on weak markets in December? Probably not. I'd like to focus on markets that'll benefit from window dressing and the typical year-end rally. So I'm looking at strength names more so than I'm looking at weakness names. But keep some of these weakness names in mind because they might be some of the names that benefit in January as portfolio managers are rebuilding and we see window undressing, quite frankly. As far as point of validity, so the point of validity of, for example, this trade here is if I have a downtrend and I'm defining the downtrend by an area of resistance, maybe it's a VWAP, maybe it's a 200 exponential, maybe it's a 55 exponential, maybe it's the wave. What is the reason that this market is in a downtrend? If that reason is broken, that is then breaking what I called many years ago to keep me respecting my stop loss. I called it a point of validity because in my mind, it's easy to argue with the stop loss. It's sort of a suggestion. A point of validity is now taking a trade past where it makes sense to keep the opinion that I had. All right. The other part is the paper cuts. So I'm not advocating always just taking small losses. I think there's just sort of this overall approach in the markets which say cut your winners quick and let your winner or cut your losers quick and let your winners run. Well, what's quick, right? I'm not an advocate of that either. It sounds good, but it's actually ridiculous to have to execute in the market because every single symbol has its volatility. Every single environment and every single period of time has a certain type of behavior. So tight stops in a volatile market make no sense. So taking paper cuts is not really about the market. It's really about our account and our risk tolerance. That's really what it's about. So when I look at an overall market and I see that there is a point of validity being broken, that's one reason I can get out. If I'm using options in a market, then the advantage is I can give a little bit more latitude because, especially in a volatile environment, I have the luxury of a little bit more latitude. But the paper cut really isn't about the market as much as it is avoiding risk of ruin in our account. Because if there's anything that I believe, and I was so grateful that I had a mentor early on in my career that said, blowing up an account is not a rite of passage. It's a fundamental misunderstanding of position sizing. And really, once you understand position sizing and risk, you'll never blow up an account. I'm not saying you'll never lose, but think about how long we have to be stubborn in executing a poor trade idea to actually drive an account down to nearly nothing. Mathematically, risk of ruin is 50%. So the idea of the paper cut is to avoid that. I've never blown up an account, not because I'm a genius trader. I've never blown up an account because I follow the math. There's market money math that we all need to follow. And part of that is, what I factor into that paper cut concept. So thanks for the question. All right. Hey, Deborah, do I have thoughts on XLF? Not yet. I wish I did. I wish we had better clarity, but XLF and KRE, what I'm thinking is we're probably going to, and I'm going to be in the Sector Secrets Mastery room here in just about 2-3 minutes. We're probably going to go and pull up the multi-charts and start to ask ourselves, are we seeing some emerging relative outperformers within this group of stocks? And if we are, we might go at a single individual relative outperforming stock level, not necessarily at the tide. So boats probably not tied on XLF. All right, next up is seasonals for the first quarter of 2022. Michael, let's get through the last quarter of 2021. And the reason I say that is because we don't want to just jump into what do seasonals say without seeing what preceded, both technically, price-wise, and seasonally, before we say, okay, this is what we can expect. So I'm not there yet. I'm going to observe how we end this year, and then we can start looking at whether or not seasonals were indeed in sync as we wound down 2021, therefore then validating continuing to use an analysis in 2022. So I hope that makes sense. All right, next up, Kay says it's not personal. Yeah, exactly. Our friend Don Miguel Ruiz, the 4 agreements. It's never personal. My frontal lobe agrees with you, but my stomach is not consoled. Your stomach, actually, Kay, if I may say so, your stomach probably believes it too, but it's going to be the difference between your frontal lobe and your stomach, the position sizing or the understanding of the risk that you're taking. I believe there's a gut brain, right? I do believe there's a gut brain. So there's probably some sort of fundamental confusion, even at a small level, misunderstanding of the setup, or you don't like the setup, or the setup's presenting too much risk. So while the brain goes, well, it's not personal, the gut's saying, I'm not happy. Find out what that is, and you'll probably find it's going to land on one of those things. I don't quite understand the trade. I might be trading too large or aggressively. And that's where the gut alarm kicks off. So yeah, we can talk about historical volatility. Sure. I'm going to jump in the room here in just a moment. Do we have shenanigans at 6:45 a.m. with the indices? Remember that, and I don't know which one specifically you're thinking, which one, but remember that. See this right here, and I know exactly what you're talking about on ES. And the thing to remember about volatility this time of morning, it's twofold. One, I don't believe we had anything on the calendar. So the first thing we want to do is take a look at the calendar and ask ourselves, was there anything scheduled at that time? Of course, it would be more of a European event. And then we have to go take a look. This is probably news driven, likely. So yeah, probably some kind of shenanigans. And I'd have to go back and look what 2 hours ago. I remember something out of the UK about the variant spreading faster, something like that. And I remember that about 2 hours ago, but we're talking now about 3 hours ago. Slowdown in China was coming up. COVID cases doubled in South Africa. So I'm just looking back on my news feed 2, 3, 4 hours to see what that might have been a sudden reaction to. But, that's a very illiquid time. And I do caution traders pre-market, be careful because it is lower liquidity and, things like this can happen very suddenly. So thanks for the question. As always, appreciate y'all taking time out of your morning to join us for Charts and Coffee. Caffeinate and dominate, my friends. I'll see you all tomorrow, same time, same station. Be good to each other. Sector Secrets, folks. I'm heading over to the room right now.